Bear Market Guide. Have you heard a lot of people talking about the bear market? All of whom are concerned and considering every opportunity to recover their stock prices, even trying to get advice from a number of experts on what they can do. This is due to the fact that bear markets happens when prices in a market fall by more than 20%, frequently accompanied by a decline in investor confidence and the economy's prospects. It may be cyclical or more protracted. The latter can last for several years or even decades, while the former only lasts for a few weeks or a few months. But there are ways to profit in downturns, including shorting stocks, buying put options, and investing in inverse ETFs. Right now, it's incredibly intriguing. Finish this video if you want to learn more so you can enjoy the wonders of learning and become an expert without having to spend money on specialist consultations. Welcome to Market Sense, where we discuss all about stock markets. But before we begin, don't forget to hit the like and subscribe buttons and be the first to check out our latest videos. You must first comprehend the bear market itself. When stocks on average fall at least 20% from their high, the markets are said to be in a bear market. However, a 20% decline is imprecise, just as 10% decline is subjective as a standard for a correction. When investors are less risk-seeking and more risk-averse, that is another concept of a bear market. Investors avoid speculating in favor of safe, boring investments during this type of bear market, which can last for months or years. Bear markets can persist for many years or only a few short weeks. A secular bear market is characterized by below-average returns over an extended period of time, which can range from 10 to 20 years. Within secular bear markets, there may be protests where stocks or indexes rise for a while, but the profits are short-lived, and prices drop back to their earlier levels. On the other hand, a cyclical bear market can last for a few weeks to several months. What then leads to bear markets? A bear market can be caused by a variety of factors, but in general, they include an insufficient, decelerating, or stagnant economy, exploding market bubbles, pandemics, conflicts, geopolitical catastrophes, and substantial economic societal changes such as the move to an online economy. Poor employment, reduced disposable income, weak efficiency, and a fall in profitability are typical indicators of a frail or weakening economy. A bear market can also be started by any government intervention in the economy. You should be mindful of the following bear market phases. 1. High prices and positive investor sentiment characterize the first phase. Investors start to withdraw their money from the markets and take their profits as this phase comes to an end. 2. The second stage is characterized by a sharp decline in stock prices, a reduction in trading volumes and corporate profits, and a fall in previously strong economic indicators. As sentiment starts to deteriorate, some investors start to panic. Capitulation is the term for this behavior. 3. Speculators begin to enter the market in the third phase, which raises some prices and trading volume. 4. Stock prices continue to decline in the fourth and final phase, but gradually, bear markets begin to give way to bull markets as investors start to once again become attracted to low prices and positive news. There is hope in bear markets, so don't worry just yet. The first is short selling, which entails borrowing share capital, selling them, and then buying them back at a loss. If the trade does not succeed, it could result in significant losses. Before placing a short sell order, the short seller must borrow the shares from the broker. The difference between the price at which the shares were sold and the price at which they were covered represents the short seller's profit and loss amount. Puts and inverse exchange traded funds, or ETFs, are the next topic to discuss in bear markets. A put option gives the owner the freedom, but not the obligation to sell a stock at a specific price on or before a specific date. Put options can be used as a hedge against falling stock prices to safeguard long-only portfolios, as well as a way to speculate on declining stock prices. To engage in such transactions, investors must have access to options in their accounts. Purchasing puts is generally safer than selling short bearing bear markets. The values of inverse ETFs will fluctuate in the opposite direction of the index they track. For instance, if the S&P 500 index fell by 1%, the S&P 500 inverse ETF would rise by 1%. Many leveraged inverse ETFs multiply the returns of the index they track by 2 or 3. Inverse ETFs can be used to speculate or safeguard portfolios just like options. As an investor, how do you prepare for bear markets? Let us know in the comments. The following tips will help you get ready for bear markets. 1. Think structurally. Verify the level of risk your portfolio is taking to achieve your short and long-term goals. This framework gives you a framework for creating an investment strategy that is tailored to your needs and in line with your individual objectives and goals. You can use this framework to make sure that your investment risk is appropriate for your current situation. Not too much nor too little. 2. Make a strategic plan. Eliminating some stocks from the portfolio in favor of a higher allocation to core bonds is the most direct way to manage equity risk. To be a successful investor, you must adjust your overall asset allocation, positioning to keep the portfolio in line with the priorities of your family. It's crucial to make sure that significant adjustments to the allocation of the portfolio are made sparingly and proactively. 3. Think about hedges. If one of many strategies were to take the place of some of the equity allocation, the portfolio's downside exposure could be reduced. In choosing portfolio hedges, we prefer strategies that don't cost the investor too much, either explicitly or implicitly, but should provide significant downside protection during a bear market because bull markets are much more frequent and lasting than bear markets. 4. Cautiously manage your outstanding debt. Borrowing techniques, when used wisely, can greatly enhance bear market returns. Investors should have a plan to pay down debt when markets are healthy. This, along with consolidating assets to increase availability and improve borrowing terms, can help ensure that borrowing capacity is available during bear markets. One word of caution: a bear market can quickly turn leverage from a carry trade to a margin call. Many investors experience fear when they hear the term bear market. However, these severe market downturns are inevitable and frequently only last a short while, especially when compared to the length of bull markets during the market is appreciating in value. Even in bear markets, there are lucrative investment opportunities. Bull markets can last a very long time, but they can't last indefinitely. And when a bull stops running, it's better to be prepared than surprised. That is why we are showing and explaining everything you need to know, and you can always watch other videos discussing different topics about the stock market. Now that you know all about the bear market, I'm certain that you're ready to learn more. Keep up with the most recent stock market trends. If you like this video, please hit the like button, subscribe button, and notification bell to get updates on our new videos. If you want to watch more videos, head on over to our channel to see more from Market Sense. See you